Hi there. Today is part 3 of the series on debt, and I shall be talking about international capital and financial flows. Before I proceed, please accept my apology for uploading my last episode a day early on Sunday. I ran a marathon last Sunday, and so in the process of scheduling the video upload beforehand, I confused the dates. And now on to today's discussion. To recap, in part 1, I discussed corporate debt and its many flavors. I shall link the video up here. In part 2, I discussed sovereign debt, that is the debt of nations or countries or governments. In that episode, we saw how governments borrow to finance the budget deficit. We also saw how these borrowings, whether domestic or foreign, enable governments to implement projects or socio-economic programs that may benefit citizens. At the same time, however, we also saw how the burden of servicing debt, in particular foreign currency denominated debt, especially for low-income and fragile states, could impact not just their ability to carry out vital programs for their citizens, but could threaten their very political survival. I shall link this video up here. Today's discussion could just as easily have been part of the International Currency Market series, but I felt that it probably fitted better here. So, what are international capital and financial flows, you ask? This is what I will answer next. But before I continue, do visit our website where I curate news and publications from international financial organizations and world central banks. Topics cover a wide range of financial and economic issues that affect individual countries or the world economy. For instance, COVID-19, inflation, or the war in Ukraine. Please also subscribe to this channel and be informed whenever we publish a new video. International capital and financial flows refer to the movement of money, investment, and credit between countries. This movement of funds is facilitated by the growth of globalization and the integration of global financial markets. As a result, international capital and financial flows have become an important factor in the economic development and growth of countries around the world. International capital flows encompass the flow of investment capital from one country to another, such as foreign direct investment, FDI, portfolio investment, for example, stocks and bonds, and cross-border lending and borrowing. These flows can have a significant impact on the economies of the countries involved, both positively and negatively. Financial flows, on the other hand, refer to the movement of money between countries to support trade, investment, and other financial transactions. This includes currency exchange, cross-border lending and borrowing, and international transfers of funds. These flows play a crucial role in facilitating international trade and investment, and can also impact exchange rates and the stability of financial markets. Cross-border lending and borrowing refer to the flow of capital between countries in the form of loans and borrowings. This type of financial flow allows countries, companies, and individuals to access capital from abroad to finance investments, consumption, or other activities. Banks and financial institutions are typically the main intermediaries in cross-border lending and borrowing, providing loans to borrowers in other countries and accepting deposits from foreign savers. This can provide a source of funding for countries and companies that may not have access to capital markets, allowing them to invest in infrastructure, research and development, and other activities. Cross-border lending and borrowing can also contribute to the stability of the global financial system by allowing for the distribution of risk across borders. For example, if a financial crisis occurs in one country, capital flows from other countries can help mitigate the impact and support the affected economy. However, cross-border lending and borrowing can also create risks such as currency fluctuations, changes in interest rates, and potential default by borrowers. These risks can be particularly pronounced in cases of large or unsustainable cross-border lending and borrowing, which can lead to imbalances in the global financial system and contribute to financial instability. Foreign direct investment, FDI, which I mentioned in passing in the episode on remittances, is a type of international capital flow in which a company or an individual invests in and manages operations in a foreign country. FDI involves the acquisition of a lasting interest in an enterprise operating in an economy other than that of the investor, usually through the purchase of a substantial stake in the company. FDI can take many forms, including the establishment of a new business or subsidiary in a foreign country, the acquisition of an existing company, or the acquisition of physical assets such as property or natural resources. The goal of FDI is often to gain access to new markets, take advantage of lower labor costs or other factors of production, and to secure long-term supplies of goods and services. FDI can bring significant benefits to both the host country and the investor. For the host country, FDI can provide access to capital, technology, and management expertise, as well as create new jobs and stimulate economic growth. For the investor, FDI can provide access to new markets, diversify the company's operations, and reduce its exposure to economic and political risks in its own home country. However, FDI can also have negative impacts, such as increased competition for local firms and potential cultural and environmental issues. It is therefore important for governments to carefully manage FDI flows and ensure that they are aligned with the country's development goals and balanced with the potential risks. Portfolio investment, which I also mentioned in passing in the same discussion of remittances, refers to investments made by individuals, institutions, and governments in securities such as stocks and bonds, with the goal of earning a return on their investment. These investments are considered portfolio investments because they are made with the intention of holding the securities for a period, rather than for the purpose of actively managing or controlling the underlying companies. Stocks, also known as equities, represent ownership in a company. When an individual or institution buys a stock, they become a shareholder in the company and are entitled to a share of the company's profits and assets. Stocks can offer the potential for high returns, but also come with higher risk. Bonds, on the other hand, represent a form of debt that is issued by a company or government. Bondholders lend money to the issuer and receive regular interest payments in return. Bonds are generally considered to be less risky than stocks, but also offer lower returns. Portfolio investment can provide several benefits, including diversification of investments, the potential for higher returns, and exposure to different economies and markets. However, it also comes with certain risks, such as fluctuations in market conditions and changes in the financial performance of the companies or governments whose securities are held in the portfolio. Portfolio investment is an important component of the global financial system, allowing individuals and institutions to invest their capital in a variety of assets and helping to provide the capital necessary for companies and governments to grow and develop. In summary, international capital and financial flows are essential components of the global economy, connecting countries and enabling the exchange of goods, services, and capital across borders.